Let me tell you something real. Imagine a guy in Texas who buys a small apartment building. Nothing fancy, just a simple 12-unit property. He decides to live in one unit and rents out the other 11. Now here's where things get interesting. Every single month, he collects rent from 11 different people. So even if one tenant moves out, he's still earning from 10. If 2 leave, he still has income. Even if 3 leave, he's still not at 0. Now, think about this for a second. If you have a job and you stop working, your income usually stops too. That's the difference. And this is exactly why so many investors are shifting toward multifamily real estate. But here's the thing most people miss. It's not just about owning property. It's about understanding how the numbers and the system actually work. Once you get that, you're not just investing, you're building wealth. In this video, we'll break it down step by step in simple language. The basic math behind multifamily, how investors increase income and value, the financing side, and even strategies like infinite returns. So stick around, because this can completely change how you look at money. Hey everyone, welcome back to John Explains Finance. And if you're new here, this channel, Whispering Ages, is all about sharing real stories, simple explanations, and practical ideas that help you understand money, investing, and life in a clear and realistic way. So if you enjoy content like this, make sure to subscribe. All right, let's get into it. So first, let's keep it simple. Multifamily real estate just means one property with multiple units. Like a duplex with 2 units, a fourplex with 4 units, or a full apartment building with 10, 20, or even 100+ units. Now let's walk through a simple example. Imagine each unit rents for $1,000, and you have 10 units. That gives you $10,000 per month in total rent. But of course, there are expenses: maintenance, property taxes, insurance, management costs. Let's say all of that adds up to $4,000. So what's left? That's $6,000. This is called your net operating income, or NOI. And here's the important part. This number directly affects the value of the property. Let me explain this in a simple way. In real estate, there's a basic formula. Value equals NOI divided by cap rate. Now, don't worry about the technical term. Let's just think of it like this. If a property is making more income, it becomes more valuable. For example, if a building is generating strong yearly income, investors will value it higher. So when you increase rent or reduce expenses, you're not just increasing cash flow, you're actually increasing the value of the property. And that's the real game here. Now, let's compare something very practical. If you own a single-family home, you usually have one tenant. So if that tenant leaves, your income stops. Now imagine a multifamily property. You have multiple tenants. So if one tenant leaves, the rest are still paying rent. That means your income doesn't completely stop. And that's the power of having multiple income streams in one property. Now let's talk about how investors increase income, because this is where the real opportunity is. Let's say you buy a building, and the units are a bit outdated. Right now, each unit rents for $900. But after some improvements, you raise the rent to $1,200. Now, here's how you'd think about it in real life. Okay, I just increased rent by $300 per unit. Now, multiply that. If there are 10 units, that's $3,000 extra every month, which means $36,000 more in a year. And the interesting part? You didn't buy a new property. You just improved the one you already had. Now let's talk about how people actually finance these deals.
Because most investors don't pay full cash. Here's how banks look at it. They don't focus on you first. They focus on the property's income. So if the property is generating good income, the bank is more comfortable giving a loan. Usually the structure looks like this. You put down around 20 to 30%, and the bank finances the rest. For example, if the property costs $1 million, you might pay $200,000 and the bank covers $800,000. Your goal as an investor is simple. Make the property strong enough so it can support itself financially.
Now, serious investors follow a plan. They don't just randomly buy properties. They usually do something like this. First, they look for a property that's underperforming. Then they improve it. Maybe they renovate the units, improve the management, or adjust the rents. After that, the income goes up and the property value increases. For example, they buy something for $800,000, invest some money into improvements, and now the property could be worth $1.2 million. That difference is where real wealth is created. Now, this concept sounds advanced, but let me explain it simply.
Imagine you invest $100,000 into a property. After some time, the property value increases. You go to the bank and refinance the property, and you get your $100,000 back. But here's the important part. You still own the property. You still earn rent every month. So technically, your original money is back, but the asset is still working for you. That's why people call it infinite return.
Now here's where the big money comes in. Most investors don't just hold the property forever. After increasing its value, they sell it at a higher price. So if someone bought a property for $1 million, improved it, and later sold it for $1,500,000, that's a $500,000 profit. That's how wealth is actually built in real estate. At the end of the day, multifamily investing isn't just about money, it's about freedom. Freedom to not depend only on a job, freedom to have multiple income sources, freedom to build something long-term. And that's why so many smart investors are moving into this space.
If you found value in this video, make sure to like and subscribe to the channel. And comment below, multifamily, if you want a step-by-step beginner guide in the next video. I'll see you in the next one.